Hello traders, Gary Wagner here, just about 10:40 in Honolulu, 3:40 in New York. It is Monday, first day of February 2016, and this is the daily report for gold and silver. We are showing a nice rally in the precious metals markets across the board. Gold currently trading up about $10.5 to $11 higher. 11.28 and change. The high is 28.99, so we are just off of the high. The low today is 11.15 on the day. Traders, as you can see, silver also trading higher on the day, currently trading at 14.35, putting it up about 12 cents or 0.86% higher on the day. The low 14.21, the high 14.41. So we are about 6 cents off the high in silver. So traders, as I'm sure you're well aware of, we are long the gold market currently. We put on one position last Monday, and then we added to that, I believe, midweek. Market now trading about 11.29, 11.28. As I said, putting it up about $11 or $12 on the day. We're looking at a daily chart. And on this daily chart, there's a couple of real key areas that we have been speaking about. The first one, I believe, that's absolutely critical, and we have absolutely formed a base, is the 1100 mark. As you can see, right in here, 1100 acts as support. Right in this area, it acts as resistance. It breaks through here. 1-2 attempts to kind of take it out. But this last attempt, the third, 1, 2, 3, third attempt was a charm, because what we saw is this market literally take off and begin to move to new territory. Now, the next real mark that we needed to see it take out was at around 11.18. Now, that is based on a 50% retracement level, and this retracement is from 11.92 down to these lows at about 10.45, and then we get all of our subsequent fib retracement levels. Now, the fact of the matter is that one, we can easily identify a three-river morning star, but the market has already been up, so you wouldn't give it as much weight, but it is a good recovery. And what I mean by recovery is typically a three-river morning star is going to be pointing out a relative bottom in the market, such as right in here. You get the red candle, the star, the green candle, and then a subsequent rally. But it came after somewhat of a defined downtrend. In other words, we went from higher to lower pricing, then had the pattern. Now, in this case, we had a rally. We had the market consolidate for a little bit. And then, of course, from there, we had a star-like candle. And then we had this nice spike up, which is today, as I said, market trading roughly at about 11.29. But that is definitely a three-river morning star. Now, our next real level that we want to watch for, should the market continue to rise, is going to be about 11.35. Also, traders, our stops right now are sitting at roughly 11.07, and the reason for it being at 11.07, that's roughly in this area, this being 10 right here. And the reason that I placed it there is what we needed to do was place it below these series of lows right here. If you recall, this is Friday's low right in here, yeah, it came in Thursday night, but Friday's low, in which I believe the low was 108.73, something like that. So for right now, maintain your current long position, maintain your add-on, maintain your current stop placement at 11.07. So traders, the next chart that I do want to look at, it is a weekly candlestick chart. We can look at it whether it's in a weekly format or a daily format. Doesn't really matter, because what we're really looking at is this linear regression, this bear channel that we need to see really taken out for us to get technical confirmation that we could possibly go into some sort of an extended rally. Now, when we first sent out this trade alert, we used this chart. Now, it was as a line chart at that point. And of course, the key difference between a line chart and a candlestick chart, or even a line chart and a bar chart, is the fact that that line chart is based upon closes only. So you're not getting the intra-week, in this case, or intra-day high. However, here we have the case where the line chart is going to be equal to the candlestick chart, and that's simply because we are up at the highs of the day, this being a weekly chart, the highs of the week. And so traders, what I have done is I have converted this into a daily chart, and of course the bear channel, or the linear regression, is going to be quite different, because it's using, the study is using the same periods, the same time points. However, they're multiplying it by days and not by weeks. So you'd actually be dividing it by 7. However, when we take a look at our daily, we can certainly see how the market came down, tested this was at one low at around 1068, roughly in that area. And then from there, we were off running away. Market definitely made it above 11. 1110 was our former resistance. And as I said, right now we're pegging our next real level of resistance up at around 34. So traders, the last chart that I do want to look at today is going to be a simple daily chart, but on this daily chart, we've got our alternative wave count, and the key difference, as you know, is that we are assuming that the top of the market, when it hit a record high at 1920 plus, was the culmination of a major fifth. The reason that becomes important is because with that in play, what we're looking for is a conclusion to the A wave, the prevalent corrective wave that has been evident in the market for the better part of the last 3 years, at least since 2012. When we do that, and as we talked about on this count, let's go through that. We've got our wave 1, our wave 2, our wave 3, wave 4 and 5 are compression triangles, of course. And on 4th, we've completed that. This is wave 1, wave 2, wave 3, wave 4. And at this point, we have broken above this upper level resistance line right in here, which makes me look at this as the culmination of a 5 out of 5 subcount, 5 out of 5 intermediate, and the culmination of our A wave. Maintain your current long position. Maintain your add-on, maintain your stop. This has been Gary Wagner, wishing you as always good trading. We'll talk to you tomorrow for another daily update and review. Bye-bye.